Bookkeeping is the foundation of all accounting processes. It involves recording financial transactions, categorizing them, and maintaining accurate records. Let's understand bookkeeping with an example. Let's consider a small business named Fresh Bites Cafe. They sell sandwiches, salads, and beverages. Here's a simplified overview of their financial transactions. Opening cash. The restaurant starts with $10,000 cash in hand. Purchase of ingredients. Bought $500 worth of ingredients on credit. Sales. Sold $1,200 worth of food and beverages. $800 paid in cash and $400 on credit. Payroll. Paid $600 in wages to employees. Utility bill payment. Paid $200 for electricity and water bills. Rent. Paid $1,000 for monthly rent. Purchase of equipment. Bought a new oven for $1,500, paying $500 in cash and the remaining $1,000 on credit. Credit card sales. Made $300 in sales through credit card payments. Supplier payment. Paid $300 of the $500 owed to the ingredient supplier. Closing cash. At the end of the day, the restaurant has $3,400 in cash. This table provides a clear breakdown of each transaction, indicating the accounts affected, whether it's a debit or credit, and the respective amounts. By applying the double entry system, each transaction has a corresponding entry that maintains the balance of accounts, ensuring accurate financial records and facilitating better decision-making for Fresh Bites Cafe.